Hey, what's up YouTube? In this video, I'm going to try and value PayPal. I'm going to use an intrinsic valuation analysis, do some financial statement analysis, check out their balance sheet, and just overall their business and try and figure out whether it's a good time to buy PayPal or not. If you're new to the channel, my name is Dan. I do stock analysis and investment videos on this channel. So if you're into that kind of thing, hit that subscribe button and check out more videos like this one. So PayPal is a service which pretty much charges a fee to help you transfer money. One thing I liked about PayPal is that they are on board with the cryptocurrency trend. A lot of central banks are trying to fight that. They see that as competition, but PayPal is in on that. Now, as far as how they make money, pretty easy to understand. Once again, 91% of their revenues are simply from charging people to transfer money. 9% come from other value-added services, which is a pretty ambiguous term and one which I couldn't really figure out even after looking at their financial statements for a while. Now, as far as where their revenues are coming from, you got a little over half coming from the United States, 11% from the UK, and 36% from all other countries combined, which I really see as being an area for their future growth. So the company has had some very impressive revenue growth over time. Remember, they offer a service that really becomes more valuable as more and more people use it. As everyone starts to use PayPal, it becomes pretty widely accepted and almost necessary to do your business. Now, because they don't require a lot of employees or a lot of office space, PayPal has been able to take that revenue growth and translate it into even more impressive growth in their profitability. Remember, their revenues went from about $15 billion in 2018 all the way up to $20 billion in the most recent period. Have a look at their net income though. It goes from $2 million to $3 million in that same time span, a 50% increase off of a 33% increase in revenues. That shows you the economies of scale, leading to better margins. Okay, so here's a DuPont analysis for PayPal. I like to get about 5 years worth of data to make sure I get a representative picture. We're going to break their ROE into 3 parts. Check out my video below in the description if you don't know about this. But the ROE is not that great, but it is trending upward, getting close to 20%. What really drives that ROE? The biggest part is net income margin. So most recently, every dollar of sales translated into 15.5 cents of profit for us. And that has been trending upward for the past 5 years. That is really wonderful, and I think that will probably continue. Because remember PayPal's business. As they gain more and more users, they really don't need to open up stores or factories or increase production. That's not their kind of business. So you're not going to see a comparable increase in the expenses. One thing I really don't love to see is the very low asset turnover. I mean, for every dollar of assets they have in place, they generate about 40 cents in sales. And finally, they have that equity multiplier. You can see they've increased their leverage over time, going from about 2.1 all the way up to 3.03. That is another factor that helps out their ROE, but it's not disturbingly high. Overall, I like their business. So here's PayPal's balance sheet. I see a liabilities to assets ratio of about 70%, which is kind of middle of the road, not super leveraged, not super safe. The current ratio, 1.38, tells me they cover their current liabilities with current assets pretty easily. Quick ratio is exactly the same because they have no inventory. Interest coverage ratio is pure cash. I mean, they've got easily enough profits to cover their interest expense over 17 times. And they're not too long-term asset intensive. They're very liquid. So overall, a pretty darn healthy balance sheet for PayPal. Alright, so before we do a deeper dive, here's just a quick look at PayPal. They're trading at about 66 times next period's earnings. That is a rich valuation, so just right off the bat, I can tell you that we're going to need to see some pretty serious growth to make this a good deal. But we will have a look. Their market cap is close to $300 billion, making this a pretty darn large company at the moment. As you can see, they are a company that is very resilient to the pandemic. One of these tech companies is pretty well insulated from the effects of it. Their stock is pretty much doubled in the past year. Okay, so to value the company with a intrinsic valuation model, I really need to estimate the revenues and then go from there. What I can see here from the analyst forecast we have is close to about a 19% revenue growth for about the next 5 years. Then it drops off, although I don't really put a lot of weight on these next 5 years here because they're based on the opinion of just about 1 or 2 analysts. But the first few years, this is the consensus of a lot of analysts, and so I will place some more weight on those forecasts. Alright guys, so PayPal as a company looks awesome. I really want to be in on this business, but valuation wise, a PE ratio of 66 doesn't look very attractive, but they are growing, so let's just put it all together. Let's use a free cash flow to equity model and try and come up with a fair value for PayPal. So the idea is pretty simple. The price or fair value of PayPal should be equal to the present value of all those free cash flows the equity holders can expect to receive. To figure out what those cash flows are going to be, I'm going to use those revenue estimates. I'm then going to try and estimate how their margins are going to be changing over time. I'm going to put them together, figure out a reinvestment rate, and ultimately get those cash flows and figure out what the fair value is. Okay, so remember the revenue growth is about 19% for the next 5 years. So I've plugged that in, then I'm dropping it to about 14% thereafter. After 10 years, we just have to assume some sort of stable growth rate forever. I'm going to go with a slightly higher, I'm going to say 2.5%, given the nature of their business. Their net income margin is about 15.5%. But we have seen that increasing over time. I'm going to assume it can increase modestly over time as it has been, kind of topping out at 23% there. This gives me a stream of net income, but if you're an equity holder, that's not the final piece of the puzzle. You need to estimate reinvestment needs. And so I have a reinvestment rate here of about 25%, dropping down to about 10%. I think this is fair given the nature of their business and their growth rate. They don't need to invest as much as some other, manufacturing type firms do. Alright guys, so if I take that stream of free cash flows to equity and I discount them back to present value using a 7% discount rate, I come up with a total firm value consisting of about $14 billion of cash on hand, $59 billion being the present value of the cash flows for the next 10 years, and $208 billion being the present value of that terminal value, for a total firm value of $282 billion, or $241.14 per share. Now, unfortunately, this is not very exciting because this is pretty close to where the stock is trading at right now. Okay, let's have a look at insider trading activity at PayPal. I see in the past 3 months you got 5 buying and 8 selling. When you look at the number of shares involved in these transactions though, it's kind of a different picture. You actually see an overwhelming number of shares being sold compared to shares bought. So overall, a slightly negative signal about the company's prospects. Alright everybody, here are my final thoughts on PayPal. First thought is always hit that like button, it really helps me. But seriously, okay, this is a really wonderful company. They really offer a service that everyone needs. People are going to need no matter what. You guys transfer money, whether it be to your friends, your family, or just doing business. And once again, it's like a lot of these tech companies where as you get more and more people on board with the technology, it becomes more widely accepted. and it becomes more valuable. You know, as more and more of your customers ask you, hey, do you accept PayPal? You're more and more inclined to go out and say, you know what, I got to get that as a form of payment. So I'm honestly torn. When I do the fair value analysis, it's definitely not a buy right now. It's probably close to fair price. So for me, I'm going to wait. I'm going to see if we can get a little dip in the stock market. Just a little bit. If it can just come down to 240, 235 or so, personally, I'm going to jump in. Even though it's not that great of a deal by the intrinsic value analysis, it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. So for me, if I can get in on this business, even at a fair value, I'm probably going to do so. As always, let me know what you guys are going to do in the comments below. Thank you for watching.